Assalamualaikum and hello everyone. Welcome back. This is the second video on the preparation of consolidated statement of financial position for simple group structure using question March 2013 edited version, where this is dealing with the last part of the preparation, which is to consolidate and do the elimination in the consolidated statement of financial position. If you are interested to watch the first video, you can check down my description. But we are going to continue with the preparation of the schedule, as well as preparing the consolidated statement of financial position. For your information, we have already done all the consolidation adjustment via journal entries, and you can go and check my video so that you can have a better view of what we have earlier discussed. So what we're going to do now is to calculate the goodwill for the acquisition of the shares and debentures in the subsidiary company. Here is Payung, and the parent company is Intan. So first is I'm calculating the goodwill for ordinary shares. This 500,000 consideration transferred CT. You can get that from the Sofp of the parent, right? Sofp of the parent, meaning to say that you can go and check your investment in parent 500,000, and you will be able to find out what is your consideration transferred. Then the non-controlling interest, since you have been informed here, the non-controlling interest is recognized at the fair value of the net asset on the date of acquisition, right? So therefore, what you need to do here is find out the net asset first, which is the fair value of the net asset. You must find out the fair value of the net asset, not just the net asset, but when you have the information on fair value, then find out on the date of acquisition what is the fair value, which is on 1st of 2000x1. That was from the information. Right, so you have already done all those adjustments earlier. So incorporate info 4, add with the bonus issue, you will get the share capital 525, retained profit. There was a deficit that we have discussed from the information 1. Go check the consolidation journal that you have already done with me. You get 90,000 because 100,000 minus the deficit on the revaluation of plan. That was the case, plant and machinery. For the ARR, for your information, property was revalued at a surplus, whereas plant and machinery was revalued at a deficit. For the property, there is no depreciation adjustment, but you need to go and include the asset revaluation reserve pre-acquisition balance by adding the extra 20,000, and that create the newly created pre-acquisition reserve 20,000 that arise on the date of acquisition. You can check information 1, and later you can also go and check consolidation journal 1 from my previous video. And general reserve here we have also discussed in information 4 and consolidation journal entry 4, which is bonus issue out of pre-acquisition reserve. The reserve utilized here is general reserve. And you have the fair value of net asset, and to get that fair value of net asset is by taking we're going to calculate the goodwill here. This is not yet being calculated, so I'm going to do it with you. This has not been adjusted, so I'll be doing it, which is going to be 20%, and that 20% is from this figure here, fair value of net asset. So that was 132,000. Right. So therefore, you have your total fair value of net asset will give you 660. So now you can see that non-controlling interest and the investment in subsidiaries ordinary shares are are slightly lower than the fair value of an asset, and that gives rise to bargain purchase on the acquisition of ordinary shares. Now we will go on finding out what are the goodwill or if there is any bargain purchase for the preference shares. For the preference shares, the consideration transfer, if you can see here, 45,000. So put that 45,000 here. And then you need to add with the non-controlling interest. To find the non-controlling interest, the percentage is here, 70%. And you will multiply it with the preference shares that you have in the subsidiary. So 30% was acquired by the parent, 70% is the one that relate to the non-controlling interest. So you have 70. You add up, you will get 115. And if you look, the preference shares in Payung, the balance is 100,000. So therefore, that gives a goodwill of 15,000 because the non-controlling interest and consideration transferred is greater than the preference shares carrying amount in the subsidiary. The next one is to calculate for the debentures in case there is goodwill. So rarely that goodwill will relate to debenture, but this one was done on purpose to show that that could happen, and I'm showing that example here, right? So for goodwill, the consideration transferred to find for goodwill for the debenture, 51, this 51, put it here. And you're going to deduct with the carrying value that you have acquired in the debenture. So debenture 80,000, you acquire 50%, right? And therefore that the total will be 115 because the total is going to be 51,000 minus the 40,000. There is no non-controlling interest to be included because this is not a share. So therefore you have a goodwill of 11,000. So if you total up these three figures, 2 goodwill and 1 bargain purchase, you will see that there is a total bargain purchase which is 2,000. In terms of bargain purchase, it has to be reassessed and checked in terms of whether the assets are being revalued, whether the fair value has been fairly stated, whatsoever. But for this question, we assume those things have been complied with, and now we can close off the bargain purchase. Where do you close off the bargain purchase? That will be closed off in the schedule here, which is in the retained profit or the group retained profit by by crediting it to the retained profit, right? So if it's impairment, you will normally debit to the retained profit, impairment loss. But here is a bargain purchase, so it will be credited to the retained profit. So it will be credited to the retained profit. I will enlarge the size here. All right, so you will see that bargain purchase here of 2,000, that bargain purchase 2,000, right, will be included here, being added to the column under the group retained profit. So group retained profit here is the column that you will have to create when you construct your schedule. So I'm putting it straight away to the column because I've already constructed. So if you were to construct, make sure you have 5 columns, 2 columns for the retained profit, 2 columns for the general reserve, 1 for the subsidiary and 1 for the parent, right? And I put the subsidiary first, the parent later, the non-controlling interest. But you can also have any order that you like. You can put non-controlling interest first. It does not matter as long as you feel comfortable. So the first thing first that you will include here, of course, I put my bargain purchase so that I won't forget that bargain purchase figure there, right? Since I have to go and include in the retained profit or the group profit. So if you have done that, fine. What you're going to do now is to find out the non-controlling interest. Non-controlling interest on the date of acquisition, take the one here, transfer here. And the second non-controlling interest of the preference shares, take the one here on the date of acquisition and transfer to the non-controlling interest column. Now we go on looking at the balance as per the statement of financial position, which is the balance as at the year end. So here you can go and check in your general reserve and retained profit what is the balance. So go and put that correctly. 220 here is from this 220. 120 under retained profit of Payung is from here. And this 60,000 is from here because this is the one under Payung, general reserve. And 84,000 is from the Intan's column, general reserve. right? That was the one at the end of the year. Now you need to incorporate what we have already discussed in the correct column. So I will not go on repeating that, but I will just tell you which one refers to which, and you can also refer later to the consolidation journal that I have earlier provided. So here are all the journal. You can watch the first video, as I said, to check on that journal in case you come to this video first. Okay, I have the journal being numbered according to the information as per the question, right? So we have to start. I'm doing the one for retained profit first. First, I have already included the adjustment for deficit. Adjustment for deficit here is relating to information number 1. Remember number 1, if you check, that was relating to the revaluation reserve, where the revaluation exercise where the planned injury has a deficit. And then there was a bonus issue. So bonus issue that was actually done in information 4. So I put here info 4. Okay, so you can check information 4, can also check consolidation journal entry 4. The bonus issue was taken from the general reserve. So the general reserve 25,000 is being reduced by the bonus issue, because then the journal entry was earlier debit the general reserve and credit the share capital. After that, the pre-acquisition reserve balance 25,000 here is from here, from this 25,000, right? This 25,000, which is general reserve figure. So I will color that here. This 25. This is from the bonus issue. Okay. Right. So you have 10,000, the post-acquisition general reserve balance. So the post-acquisition general reserve balance, because this one has less adjustment. So the 8,000 here, this one is actually 10,000, which you have to go and multiply with 80%. You will have 8,000. And this 2,000 is the difference between 10 minus 8,000. So you have 2,000, or this is 20% from the post-acquisition general reserve of the subsidiary. 20% belongs to the NCI, 80% belongs to the group. So group reserve are now done. This figure, 92,000, you can later transfer to your statement of financial position. Group general reserve will be this figure. Now we are focusing on the adjustment. So the first adjustment that I include here is adjustment according to the information that I've done. Information number 1, I cross-refer, easy for us to refer. So this one, depreciation adjustment, the over provision. So if you want to see, this is the adjustment here that you have, over provision of depreciation, which I have included here. Just some quick view. This one, right? That is the one that we have already discussed earlier, so we won't discuss it here. And then you have the adjustment that also affect the subsidiary. I'm focusing on the adjustment affecting the subsidiary first. The intercompany sale of asset, which is in number 3, where there was an intercompany sale of motor vehicle. The seller is the subsidiary company. So the unrealized profit was 10. Go and check the working in my first video. And the depreciation adjustment here is 2,000. How do you get unrealized profit? Compare the selling price with the carrying value on the date of acquisition. So that will be removed. However, the depreciation will be added back to the profit because it has been over provided. Information number 5, that's number 5 and number 7 now. So that is the only thing that you need to adjust for the retained profit, because you have already done the consolidation journal. That are those things that relate to it. And for that purpose, you can now total up what is the reserve figure for your retained profit of the subsidiary and take your share of profits. So your share of profit would be 14,000 multiplied by 80%, and you get 11,200. And the controlling, non-controlling interest or non-controlling shareholder will have that different, which is 2,008, or you can also take 20% from 14,000. Okay, this few things here that I'm highlighting are those things that would affect the parent. So information number 5 was regarding dividend or intra-group dividend, where the subsidiary company has recorded but the parent has not credited the preference share dividend. You can check that information. Go and download the question that I provide at the bottom there and check and do it with me, so that preference dividend and the interest receivable has not been credited. So now we need to go and credit. To credit is to take the amount that was given here and that was given in the question. The amount given in the question for the preference dividend was 6,000. That is under the column of the subsidiary, and you will multiply by 30%. Why 30%? The parent share under the this is the preference dividend, right? So you're going to eliminate that preference dividend of 1,008. So if you check the preference dividend, right, so what you will eliminate is the one that you receive from the subsidiary. So you can check your working here. You can check here the working, right? So this is to record the preference dividend. The preference dividend has not yet been credited, so now we need to go and take credit, which is taking the percentage that has been acquired. Okay, percentage that has been acquired is 30%. So that is why you have the figure here to be 30%. So I will put the calculation for you. 30% times 6,000. For the debenture interest also has not been recorded. Remember, this is situation number 3. Yeah, situation number 3. Subsidiary has recorded, parent has not taken into consideration. So that can also be calculated here. 50% the amount that you acquired times 9,000. 9,000 is the debenture interest payable in the subsidiaries column. So you have 4,005. So you take credit, but later this will be eliminated. Then you have the unrealized profit, information number 7. Information number 7, we have already done it before. Yeah, you can check here, information number 7. Okay, information number 7 on the unrealized profit, right? So let's check that. And unrealized profit on inventory was 12,500, where you are given the margin. So it is 30%, and that 30% is from the unsold inventory. Unsold inventory was 50,000. So you will get the figure 12,500 to be removed from the profit. Bargain purchase done. So now you have done all the adjustment, nothing else. You can now total up the retained profit column of the group. You will get 227. You can also total up the non-controlling interest, 206,800. You have done so for your group profit. Group retained general reserve, general reserve, group general reserve. Now do all the adjustment for the intercompany adjustment. Do the adjustment for intercompany transaction. So you have to show the property that was at a surplus and then record the deficit, eliminate that, and also eliminate the over provision. The same thing for motor vehicle. You will have to minus or take out the unrealized profit and adjust for the over provision. As I said, check the working, check the journal that I've done in my video so that you can have a better view of what I'm doing here. All right, for the inventories, eliminate the unrealized profit. For the account receivable, eliminate the balance of intercompany amount owing. For bill receivable, we have done this much earlier, eliminate the undiscounted bills. I've put some notes here to help you understand better, right, of what will be the issue of each of the items. So I'm sharing it with you here. You can refer this later. Take time to digest, take time to understand, because consolidation is a tedious process. So take things easy so that you can at least understand bit by bit. Okay, so you will have to check your bank balance if there is any adjustment. I would also suggest, if possible, show the cash in transit. You can also include that in the bank balance if you do not want to have a separate row for cash in transit. Here I'm adding it, yeah, because I eliminate the current account balances, right? So you have the consolidated figure here. That was the figure 2263. Remember, I told you earlier, for the ordinary shares, you will not report the one of the subsidiary. That's why it is left blank here. For the general reserve and group general reserve, group retained profit, non-controlling interest, those are all from the schedule. You can see the schedule here. I transfer the color according to whatever we have calculated and put the color there. The debenture, you add the debentures, combine them first, then eliminate the amount acquired. Accounts payable as well, combine and eliminate the intercompany amount owing. Ordinary dividend payable, combine, bills payable, combine them, right? Combine them, then eliminate the undiscounted bills, right? Undiscounted bills were being eliminated. Next, the last three, combine the dividend. You can do like what I did here, combine and eliminate all the intercompany transaction. When I say eliminate, we need to go and remove. This 40,000, remember, was the income from the subsidiary that was credited to the parent here, right? In the consolidated statement, sorry, not in the consolidated statement, sorry about this. It was here. The amount here, so that has to be removed. So now we are removing it. So we remove it here, 40,000. This is the one that was earlier credited in the consolidated retained profit schedule, group retained profit. Remember here, we add those things. But for consolidation purpose, this 1,008 and 4,005 will not be reported. So it is being eliminated here, right? So here you have the final figure. So it is 2263,500. We are done. And this amount, where you get this 40,000, it is from paragraph 1. You are informed that is the amount. Okay, with that, I thank you for watching. Yeah, thank you for watching. Go and practice more so that you can have a better understanding of this topic. Right, this is the consolidated statement of financial position, where I have used a worksheet format to make things easier for you to understand, with some little notes here and there. And this is, as I said, the consolidation journal. Go check the first video to understand better on this, right? And this is the working for goodwill and bargain purchase, and this is the computation of group reserve. I'll thank you again for watching. I'll see you in my next video. Keep practicing, and only through practice that you will get better and better each day. With that, I'll see you when I will see you. Assalamualaikum, and have a nice day ahead.